All the signs are there. I mean, as I said, the housing market is definitely showing us that. We have had yield spreads that have been telling us we have had the worst and the yield spread inversions that we have ever seen. We have had, we have the largest equity bubble, asset bubble, everything bubble.
Hello, everyone, and welcome to Wealthion. I'm Maggie Lake, and today we're going to look at the global risks and opportunities with Henrik Zeberg, head macroeconomist at Swissblock. Henrik, wonderful to have you on with us.
Thank you very much for having me on.
So it's a great time to catch up with you because I think we have a lot of mixed messages that investors may be trying to grapple with. There are a lot of concerns swirling around bonds, deficits, tariffs, just to name a few. And yet we've watched U.S. equities at least rally strongly off their April lows. And, we're having a conversation about whether, it's rest of the world and the end of U.S. exceptionalism, or maybe not. Maybe there's a tech revolution. There's so many differing opinions. What's your larger macro view of what's taking place?
So I think, unfortunately, that we are seeing the business cycle coming to an end. And as is often before, we'll see that there will be a lot of narrative, a lot of talk about what will cause the economy to come to a stall. I don't think it will be the tariff. I was very vocal about that also in April and before that, about that this will not be the tariffs that sends the economy into a tumble, but it's actually the structure of it. So. But from the 40,000 feet, I think there's a lot of talk about what can be the reason for the recession. Now we've seen the markets actually starting to soar and rally higher, which is actually also what I expected in April. But that's not the same as everything is fine. I think a lot of people will take it as the all clear signal, but it's definitely not. And the big thing that I honestly do not understand why nobody is talking about, it seems like. It's just something that runs in the background. This the slowdown in the U.S. housing market. It's really, really looking, as like it's frozen solid. So, and to me, that is one of the big components in a slowdown here. You see that there are, normally two major components to the economy. That is the housing market and the labor market. And the labor market has been standing kind of strong for now, and I say strongish, but the housing market has been really bad. And I think the latter one is what actually will pull the rest of the economy down at some point.
So just to be clear, when you're talking the end of the business cycle, are you talking the U.S. only, or are you worried about a global slowdown?
So where the U.S. goes, the rest of the world goes. It's still like that. The U.S. is still the main driver of economic growth here in the world. And I think if I couldn't see a situation where the U.S. will be running into a recession and the rest of the world will not fall into a similar thing. So I think the rest of the world right now is actually leaning up against the U.S. at this point here. There is not a lot of strong signs. If you look to Europe or to Asia for that matter, China does not look too good either. So I think that for now it's been the U.S. and the strength of the U.S. economy that has been keeping the rest of the world up. And it's the moment when we don't see the strength of that continuing, then I think the rest of the world will follow along or actually become a much worse place than the U.S. So I think it's a global phenomenon. I think when I talk about the end of the business cycle, my business cycle model indicates that it's the entire world that will fall into a recession at some point. We're not there yet. I want to emphasize that. And there's a difference between actually seeing the Titanic hit the iceberg and getting the structural damage to the hull, which will actually make it sink, and actually seeing the ship sink. And that's the difference, where people are thinking, oh, but maybe something can be done at this point. I don't think there's much that can be done at this point. I think we're way past that. And at this point, it's more like, how long will it stay afloat, even though there's a big hole in the hull?
So we're talking about the Titanic. So I know I'm going to take a deep breath here, because I think that we should sort of maybe brace for what's coming next. But it sounds like you think we've hit the iceberg already.
Oh yeah, we did. I mean, and all the signs are there. I mean, as I said, the housing market is definitely showing us that. We have had yield spreads that have been telling us we have had the worst and the yield spread inversions that we have ever seen. We have had we have the largest equity bubble, asset bubble, everything bubble that we have ever seen. So I find it difficult why people think it's a recession is not something that could be at least a probability at this point here, and we think what is going to keep things afloat here? Right now, we say, well, it'll be the U.S. that can just pull, keep pulling. For now, we have seen that the labor market has been staying strong. People haven't been laid off in large quantities at this point here. But I think there's a slowdown, and you see that the U.S. consumer is not happy at this point. We see the delinquencies around, whether it's mortgage loans or whatever, credit cards and so on, is actually soaring to levels that we have seen. So there's a lot of things out there that is not looking good, and it's actually resembling very much the situation we had before 2008.
Yeah, and people and some people also reference it, in 1999. That before the .com crash, you got those periods where things continued to rally, even
Correct.
though the fundamentals were deteriorating underneath. And I know people are concerned about. So it sounds like we've got a short-term situation, and then we have this longer term, we're sitting on a sinking ship, you believe, situation. Let's just focus on the short term for a second, because I think this is causing a lot of where the confusion or the sort of stress and anxiety comes from, because people may agree with you, especially if they're connected to the real economy. The problem is you've been watching these equity markets rally off this April low, especially the US, and even the sector that everybody said was done and dusted, tech, that's been leading as well. And if you're not in it, you've left massive gains on the table. Why would we see this equity market rally so strongly when we've got these warning signals that a serious recession is coming?
Because the market is not working as an efficient machine. It's not like that, as you mentioned yourself, like in 1999, we saw the market could just keep going up higher and longer than anybody expected. And we also saw it into 2007. We also saw the market rally on, even though we had a lot of concerns already. Michael Burry just, famously was out in 2006 already, and before that. So you can see some of these structural damages actually, getting or hitting the economy before we see that the economy actually rolls over. And at this point here, you're looking at, we have had a 4.5 trillion in terms of extra liquidity coming in, M2 I'm talking about here, in this year only alone, 4.5 trillion. Just think about that's a huge number of liquidity coming in. So right now, the liquidity coming from central banks, not so much the US still, but the US is also starting. But from the rest of the world, China and also Japan especially, we will see that comes into the market, and that will create a situation where equities can rally for longer than we can expect them to, if you look from a more fundamental perspective. Does that mean it will continue? Not in my book. In my book, it comes to an end, and you'll see that end is closing in. There are some levels that I was not one of those calling it in April. Actually, I was standing there in April 7th and April 9th and telling our clients and saying, well, I don't think this is it. And I actually said we're going to see a very, very strong rally from here, because this is an overreaction to the situation at this point. There's no recession at this point. It was so clear. And we have seen exactly that. So I think this is now where everybody's now piling into it again and saying, oh, everything is fine. We got, there's no trade war. And Henrik, why would you even think this should be a recession? And then you actually get the opposite situation. So I'm, still long. I think we'll have more of a slowdown into the summer, but then I think it will continue somewhat into the early autumn, and then I think you're going to see a top there, which will be much higher, 6,800 on the S&P as a minimum, and then I think that's going to be it. And most people won't recognize that it'll be a top before we get a little further down the road, because nobody really rings a bell at the top.
You stole the exactly what I was thinking. No one rings the top. So rings a bell at the top. My concern, Henrik, when I'm listening to this is, if we've got this potential for a rally, everyone is going to chase that. And then from past experience, people can't get out the door at the same time if it turns. And I think especially now, and let's use even the 2008 experience. We know that it's immediate, right? Information is quick. Algorithms are driving things. People trade off their phone. We saw this with Silicon Valley Bank. That bank failure happened so quickly. So that rush for the door is going to be even more intense. From where we sit right now, do you think people are investors in general are overexposed to equities, to U.S. equities especially?
Well, I only have limited amount of experience if you compare to some of the real big ones out there, like Warren Buffett, which is one of my personal I don't know, at least somebody I look up to in terms of how he should do things. And we all know that how he has been deleveraging, or at least de-risking, I would say, not deleveraging, de-risking over the last many months here. And I think that's probably to not to be in a situation where he has to do it when everybody else tries to get out the door. So the answer is yes. I do think that a lot of people are. I am the same. I'm actually risk on right now, in my portfolio, because I think I'll manage to get out in due time, but there will be a crowded situation at some point. But the answer to your question is yes. I do think that people are not. It seems like there is no, people really can't comprehend why there should be a reason for equities to sell off. But as we saw into April, when fear starts to hit, it can be really, really quick. And the bubble here, looking at PE levels, looking at market capitalization to GDP and all that, it's just through the roof compared to what we have seen before. We are at 200% market capitalization to GDP, and 1929 was around 100%, and or I think it was even lower than that. In 2007, we were at 107%, and in 2000, which was a crazy bubble, we're laughing at that, which was 130%. So now we're 200, and nobody's saying, yeah, well, Henrik, I don't really see the bubble when I talk about with people saying the bubble. And then you have a crypto market where everybody thinks, and I'm even long crypto at this point also, because I think we're going to have a crazy rise into the top of it. But you see, everybody's thinking that, crypto is going to be a fantastic thing, even though it generates, zero returns. So we have all the meme coins, and they have crazy valuations. I mean, 10 years from now, we're going to look at this and say, what were we thinking? And just like what we have done before. So as I see it, we have a crazy bubble, and we're all living in the world of the crazy bubble, and nobody likes the doomster who's standing there and saying, hey, this is not real, guys. I don't think it's real. This is not real. And yes, so the answer is, if you are prudent in your investment and education kind of, then you'll probably say this is the time to take some chips off the table. Even though we may see the market rally, but nobody likes to see the market just running away from you. And I think
sitting
that
on
is
the
probably
sideline and sitting on the sideline. That's the problem.
Exactly.
That's I mean, I want to say it's called greed, but it's not. It's also trying to sort of maximize the situation. Thank you for being so honest about sort of saying we're all going to sit there and regret and saying you're long too chasing it and you think you can get out. This is the thing. So I mean, I'm taking this as an opportunity to take a look. I think you're saying everyone should be taking a look at what they're doing and how they're positioned and what your time frame is. If you are a trader mentality and you think you can manage this last stretch, if this is true, then you've got to be super active and super nimble. If you are not that person, this is the time to go check in with someone and take a look at your portfolio and see what you want to do with risk and have them scenario run it, right? Say, if this is going to happen, what happens? If you're in that position, by the way, you can go to wealthion.com/free and get a free portfolio review by one of our endorsed advisors. So please do that if you want. You're not alone if you don't have help already and are self-navigating. So Henrik, this is a worrying picture you paint. What is, and let's stress test that scenario. What do you think the trigger is, though? You say not enough people are paying attention to this, and like we can all see that housing is collapsing underneath, and yet we keep rallying. What's the trigger to turn it? What happens that causes this equity blow off top to turn?
Well, we can ask ourselves the same question back in 2008. What was the trigger? And 2007, actually, the recession started in December, the month of December, and the market top was in October. What was the trigger in October? There was no trigger. So this is the thing is that
it just runs out of oxygen.
It runs out of oxygen, exactly. And at some point, you just get to a certain part. What is the trigger when also if you getting elevated, shot up into the air, what is that going to pull you down? Well, there is a, gravity back to Earth. So Earth will pull you back down. And this is what we're looking at right now. Of course, we can still, can rise for a certain amount of time, but at some point there simply needs to be some kind of reality to it. And I think that's what we don't have anything of right now. That there will not be a trigger, but it'll be that the situation at the evaluation level will just come to a point where it's somebody was going to maybe it'll be the credit facilities of some bank or something. I don't know what it's going to be, that it'll just slowly start to deteriorate to a degree where things will then things will top out. So I don't think there'll be a trigger, and not be the Lehman Brothers kind of thing. I think the Lehman Brothers kind of thing, and the Bear Stearns, they are the black swans that you see inside the recession. That is because the situation now becomes so severe for the consumer that at some point the banks are starting to have problems, and then you start to have so it's the situation that becomes more and more like the frog sitting there in water that becomes hotter and hotter. All of a sudden, it needs to jump out, and I think that is what we will see here as well. The situation is already there now. We can see it. We can look at the consumer. We can look at the credit card delinquencies, mortgage loans, and so on and so forth. We have all the data there, and I don't think it's happening right now because there's simply so much more liquidity that seems to be coming in right now, where the economy is still growing. But at some point it will roll over, and the business cycle model that I'm following here or using is simply clear on that. I think we have another maximum 6 months, and then we'll be in a recession.
What about this argument that this is a bifurcated economy, and that it is true that I don't even want to say the lower end, but the folks who live in the real economy, who have to borrow, who have car loans, who have mortgages, who need to come up with a down payment, who may be, hourly workers, are hurting, and those consumers are who you described with the delinquencies. But the wealthy,
Correct.
even though they're a smaller percentage, are doing really well. Assets are their net worth has grown enormously because of assets. They benefit from the higher interest rates they can get off of the bond yields sitting in cash, and that they're driving the economy and will continue to do so. What about that? Does that just extend it, or is that a scenario that didn't really exist before the economy got so financialized?
I think that is how we would like it now. I don't know if we would like to see that way, but I think the reality is that the main economy is the bottom 70% of the people in an economy. That is the real economy, and the top 20. Then you have the next 20%. They probably will be okay, and the 10%, we know the top 10% is doing fantastic. In either kind of environment, but the 70% is what drives the growth and the economy by down the road. And if you look at the banks there and you look at their losses that they're going to have, if that 70% is not thriving, that is the problem. And that's also, I actually think we're going to get another financial crisis also. I know Yellen said famously that there would not be another financial crisis in her lifetime. So I hope she's all well, but I do think it's going to happen within the next few years, because that 70% will be a huge drag on the banking sector if they start to realize some of the losses there that they might encounter. So I think I don't follow that with the 10 or 30 or 20% there. I think it's about the 70%, and that is it's not looking good. It's a more slow driving kind of a slow kind of topping process, but it's something that is happening. It's real people, and it's if they stop to spend, the 30% will not be able to do anything about it.
What do you make of the fact that gold is rallying in this environment? Because in a blow-off top, I would think that it's all sort of risk assets. And you mentioned it. We've got equity. We've got tech again. We've IPOs off the charts. We have, crypto rallying. What do you make of the fact that gold's rallying? Is that just people chasing momentum as well? Or is that a signal that maybe not all is well, and that there is a huge desire for a safe haven?
I think maybe gold is. I mean, also into 2007 and and 8, we also saw that gold actually did well into that period, and then we saw actually that gold after into the deflationary bust. We saw gold not doing so well. I think maybe this time around, because we have had this whole inflationary kind of narrative, that we've seen gold actually shooting off into the highs here. What I also notice is though that gold, and if you look at gold and silver, platinum, and all even the gold miners, their gold has been the odd man out and actually been overperforming. So I'm actually thinking here that maybe the narrative has been driving things a little on that inflation is coming, and we're going to see that's where gold normally would do well. So I think maybe the narrative has been pushing gold up to highs here, and I think it can even see gold moving up quite higher than what we are now into this kind of top here. So I think it's the narrative. And that's normally what drives the a bubbly kind of environment. So I don't say gold is in a bubble, but I'll say that it's been front running things a little here, and maybe front running it a little too much. Because I would think still that in a deflationary kind of environment, and in what we saw in March 2008 to September, October 2008, where things are starting to unfold, the liquidity is not present, banks are experiencing big losses, that gold actually will be sold off in that period where cash is king. That's where you need liquidity to.
Right, exactly, in that kind of downturn. Okay, so let's I want to finish off with the short term, and then we'll get into what plays out in this longer term so that people can prepare for it if they want to get ready. We are in the last stage of this boom time. So we're seeing equities fly. You think S&P to 6,800 possibly. We have gold maybe a little overshooting here. And Bitcoin, what's your feeling about crypto? Does that continue to ride? You mentioned you're long it. Are you expecting continued moves? How high could Bitcoin go? And does it spread through the crypto ecosystem?
No, so I'm not a Bitcoin maximalist or anything like that, or thinking that crypto is going to save the world. No, absolutely not. I think crypto is like, there will be a few of these projects out there, 1, 2, 5, 10 maximum of the thousands of them, that maybe where the technology down below and the solution to the real world will actually come and make a change to some businesses around the world. I'm not clever enough to see which one it'll be, but that's what I see, like that they will do. But they the majority of this is a risk on in the asset. It's because we see the liquidity coming in. We see the 4.5 trillion in M2 of in this year 25 actually in M2 coming in. So that is what is driving this kind of FOMO on the. So to me it's a bubble. I have to say it's a bubble. Nobody likes it, but it is a bubble that will at some point come to will burst. But Bitcoin, it has got wider acceptance, and I think it will have a place in on the asset shelf, so to speak, over the next for maybe forever. But I would not be holding any of that going into a deflationary bust. I hold it now because I think that when you see this final FOMO and blow off top, and I think it can be much more on the crypto side, crazy than what we have experienced before, and into 21, the top there, in 2017 also, because it's so widespread now. Everybody kind of accepted now that this crypto is a thing, and the SEC is now embracing it, and so on. All these things here, and I think it's gonna go just vertical into the final phase of it, but it will also catch a lot of people on the wrong side there. So I'm holding it into that kind of FOMO environment, and then I'll be hopefully clever enough to sell it off when it peaks out. And I would not be holding it. I don't see it as any kind of safe haven asset in a recession at all.
Interesting. And what about some of the other areas of crypto? We see ETH on the move. You mentioned altcoins. It feels like if it's a cycle that we've seen before, people would be a little bit burned by some of their experience, or no? Are you going to see people chase that and try to capture those short-term gains?
I think what you normally see is that Bitcoin is the one that drives the move. So everybody moves into Bitcoin, and everybody talks about Bitcoin, how fantastic it is, and it drives a lot of capital into it. And then at some point, people start to think, oh, maybe there are some alternatives out there. And then Ethereum starts to move. And, that's what we see now. We actually see Ethereum over the last few weeks here having overperformed Bitcoin. That is the Ethereum phase. And then your next phase will become where people are saying, oh, now Ethereum has been working up and moving a little too far. Maybe we should think about some of the other alternatives, and then it moves down. And what you see there is the normal risk, rotation into more and more risky projects. And I think it's going to end up down at the really end of it, things where some of these completely nonsense kind of coins and tokens are just going to take off one more time, and everybody will be full one more time into it again. I mean, it's the animal spirit, and we are all greedy, and I think that's what we're going to see, unfortunately, because a lot of people will get burned. And the reason I say unfortunately is because if you're investing into something which actually made a return, you could sit on that stock, and then probably in a few years' time it'll go back above the all-time highs, and you will also receive a dividend. The only reason why crypto is making a new high is because there's somebody next to me or behind me that is willing to buy it at a higher price than I bought it. It's not because it has created more value or anything like that in the meantime. It's simply, I have something here and we agree that it has a value today, and then somebody says, oh, I'll give an extra $10 for it, and then he gets it. And somebody will be standing with that at the end of it when it starts to drop. And I hope not to be one of them, but I fear that a lot of, especially young people, are going to get dragged into this at the very end of it.
That's a really worrying outlook, because there are real consequences to that, and there's also, I think it sort of deteriorates ultimate trust in investing. I think think that, but that's a whole other conversation. But with any of these blow off tops, it's so worrying because there's generational pain done, and there's a lack of willingness to even participate, which I think feeding into the fraught situation we have, that's a real problem. So we're going to go from that worrying note to something probably more stressful, but I think this is really important because it sounds like there's a really unique opportunity to prepare if this is the case, because while everybody else is stuffing their gills with speculative stuff and thinking they can time the top, because that's what's happening, if you're right, then there's an opportunity to maybe take this moment to prepare a little bit before everybody else tries to run for the same destination. So first of all, let's sort of put some meat on the bones of this downturn. So what are we looking at? Are we looking at a recession? Are we looking at something more serious? It sounds like you're concerned.
I am actually very concerned because I think I know that they gave Bernanke a Nobel Prize in economics for reinventing money printing. And I think that's probably one of the stupidest, and I'm being very harsh and direct here, and maybe that's just my nature, but I don't think that anything new has been, has occurred with what they call modern monetary thinking or theory here. It is actually that they have been trying to push down the yields, and that will then encourage more risk taking. And when you get to a certain level, the yields are so low, then valuation will just go berserk, and that's what you see to a certain degree. You'll then see a trickle down. The way you do valuation is that you take, if the interest rate is at 3%, 4%, you'll say, okay, I got a certain cash flow, and I'll divide it by what else I can get in the risk-free market, and then you'll see that the lower that gets, well, then I'm willing to take on more risk. That is what has been happening, nothing else. And then they have done it through some ingenious kind of ways of trying to just cover it up but it's really down the road. It's just about making people take more risk on, and that's what we've seen. That's why the S&P is up 700-800% since 2008. I mean, it's a ridiculous kind of move that we have seen in the stock market here, and in everything else, in assets across the in anything we look at. That's why we have the whole crypto market and anything else that where also, if you look at the companies, startup businesses that have been valued at extreme levels, you have all sorts of expectations of unicorns out there, and all sorts of business models that do not really hold water, and they've been evaluated at extreme levels. But anyway, so I think we have a situation here where valuation has been pumped up with this, and you can keep that illusion going for quite some time. But at some point, you're going to see inflation coming back into the system. And I think we had what I call the inverse Volcker moment after Corona. So all this money printing has been going on since 2008. But I think 2020 was when we saw that this was overdone. The Fed and the rest of the central banks around the world and administrations overdid it. So like in 1981, you saw that Volcker came out and killed inflation famously by hiking rates, and we got a recession. I think here we saw the opposite, and from the downside, that inflation, the deflationary pressures were so strong. Everybody thought we could just do whatever we want, and then we were crazily stimulating demand into a supply crisis, which the Corona was, which creates inflation. And what does that create now? That creates an inflation on the backbone of people. So thinking, oh, actually, there is something called inflation, and it can actually hurt me. And I think that is a big thing that has happened. And if you look on the long-term charts, I have a chart of the 10-year yield. You'll actually very, very clearly see that the yield, the 10-year yield now has jumped into a new level like what we have seen before when we have inflationary rates, so inflationary periods. So I have a chart that goes more than 100 years back, and you look at that and you'll see there are inflationary periods and then there are deflationary periods. And we are now stepped into an inflationary period. So why do I go through all this when you ask me, why would this be this severe? Because for so long, since 2008, we have been thinking we can actually just pour liquidity on things and then everything will be fine. I think they're going to find out this time that when the deflation hits first, and I think that's what you're going to see first, then they're going to come out with their guns blazing again. The Fed will save the day, but they are actually going to trigger a stagflation. Because that is the moment where we sit and say, well, I'm saving $1,000 a month now on my mortgage loan or whatever, but the problem is I'm not going to spend it because I saw inflation, because I saw yields rise, because I saw unemployment. And I think more people now this time around not be spending that money, and that's where you'll see that the quantitative easing, monetary, stimulus will actually become less effective, much less effective, and you'll see that the real economy will take much longer to bottom out, where all the money that they are going to send into the system, which they are actually already doing now, and it will find its way into commodities and the likes, which is then we'll see a kind of a spiral going into the coming phase after the deflationary bust. So for me, there is this blow off top. There is when we then start to see the deflation. I think the Fed is going to react, but then I think they are going to trigger something which is actually worse than a deflationary bust. A deflationary bust, like in 2008, you pour a lot of liquidity on it and you can actually create a demand, and you can create that for a certain amount of time. But if you keep doing it like what we've done, then at some point you're going to see inflation coming out. And I think that's the point we are.
Why does it go into commodities? If there's no demand, why do you have commodity inflation or any inflation at all? We know last time it was because there were supply issues. But if there are not supply issues and you're just talking about stagnant growth, why would stimulative measures from the Fed result in inflation? If I'm not going to buy, then I'm not chasing goods.
But that's going to be the problem, actually. Yeah, and you can say also that there are many reasons why inflation could be moving up. It can also be because we can see supply issues again. The same.
This is where the timing and the tariffs start to matter, right? If we are in a deglobalized world while this is happening, then they're not connected.
That could make it worse.
Yeah.
Yes, exactly, and that's why I think it's probably could be like that this time around also as well. So you will see that problem, that kind of rotation into commodities this time. And also because technically it seems like we have seen a commodity bull market actually taking off here. It's something that we have seen been pushing lower for quite some time. Then since the corona stimulus came out, we saw a new commodity leg higher, and now it seems like we are in a correctional phase. I think it's going to push lower. But again, something shifted. It was a big shift that we saw in 2020, and I think that can kick up. So that's technically, but it's back to the supply chain issues that I think we could see with the tariffs and with a less globalized world that can push prices higher in the coming years.
What we haven't talked about the fiscal side. So in 2008, it was the Fed. It has been for a long time central banks trying to manage this and buffer cushion recessions. If you think they've run out of ammunition, what about the fiscal side of things, or the legislative side of things, not just in the U.S. but around the world? Might a recession jar them into action that is useful or can help?
100% that they're going to do that, but that will be even more so a driver of inflation as I see it. And I think the thing is, we would like to see the moment we kick in with stimulus that it actually comes right into the labor market and things are just fine there in the labor market right again. But it requires, whether it's fiscal stimulus will be more direct, and it can go let's go build a bridge somewhere, and I think there will be more of that. But I also think that can be a driver on the shorter time frame of more inflation. Again, as we said, also depending on the whole situation there, again with the globalized trade in mind and all that. But I think now we have all this money that has been there from the monetary side, and if you add on fiscal stimulus as well on that, then I think inflation can be faster. And if you do not get the fast move in the labor market on the private side as well, then you can also be looking into a more stagnating bottoming process of it. So, but again, we are a few years out here, a year, 2 years maybe out, and I think it'll be interesting to see how it all develops. Whether we will see this first of all, the recession, obviously, but also how they're going to react to it this time. But fiscal stimulus is absolutely also what I expect. And you already see that also in Europe. You see Germany also starting to spend a lot more than what they've done previously.
Yeah, I'm glad you mentioned Germany, because it's not just the U.S. facing this problem, right? We have high levels of debt, declining populations, all of this that causes a lot of concern about the long-term sustainability. But because we have so many countries dealing with this, do you see any kind of coordinated action or global policy, again, that might help mitigate some of the fallout?
I can hope that we will see that, but there are just so many things we can do, and again, it's about getting the consumer to start spending. And will we send money to them directly? We'll send money to the fiscal stimulus, like what we saw in
Checks,
also during
right?
Corona. Checks, right? Yeah, but we also saw that what that can do to the economy in terms of inflation. So I think that it will be a tricky situation. It's easy when inflation is at 0%, and we don't have the inflation expectations building. But the problem right now this time around is that inflation expectations have been moving up. They're quite higher at this point, and I think that is what is going to hurt and it's going to harm any kind of stimulus that we could see. So, but yeah, I would think that we will see some kind of coordinated attempts to stop this, and especially if we get a stagflationary environment, there will be a need to do that, because there will be no kind of stimulus that will be able to help us at that point. It needs to be a structural kind of reform. It needs to be return to sound money. It will need to be, monetary reset, as I think it's that we'll see down the road, where we say, okay, we know now that we cannot just print money in, abundance. We actually need to have some kind of restrictions to that, and we will adhere by these rules. And then you'll kind of see that a new monetary regime is going to be established, but that's further down the road, and I don't think you will see that before you actually. So again, this is about keeping the phases right. I think the deflationary phase is what hits us first with the hammer, and then the easy. Let's print ourselves out of it, because the Fed is what can react first, and before you see the politicians start to wake up. But then, as inflation maybe starts to come back, I think you're going to see that it'll be a problem that the politicians will need to do, and also, as you suggest there, in a combined or a coordinated kind of attempt to limit the devastating effect of stagflation. We saw 8-9 months of stagflationary-ish kind of conditions in after Corona, and that was not a good time for pension funds and the likes, because if you're in bonds and equities and both of them are declining, well, then you see your pension funds actually having a problem. And I think down the road we could see something like that as well.
Yeah, so much for 60-40, right? That's correct.
That's exactly. That can be the problem. Yeah.
So if you expect a financial crisis, I mean, the ghosts of 2008 haunt a lot of people. That was very painful. Are we looking at something that's serious? Is it a serious recession? Is it something more substantial in terms of things blowing up? How do you see this? What are you most concerned about?
Well, I'm actually concerned about all the same things that we saw in 2008. I mean, it's when you have just valuations this time around, it's just much higher, bigger, and you see that the global indebtedness is much bigger than let's say it will be corporate, it'll be private, it'll be national nations, and so on. It'll be the whole thing there. So it'll be a debt crisis again, and I fear what that will bring about again. The deflationary part of it this time around, I think they kind of solved it. Last time they were a little more hesitant. You can see out into Corona, they were not hesitant. It was like, boom, just a lot of stimulus on it. And I think maybe you'll see that same thing again. What I'm really worried about is the second phase. So it's not the deflationary part, because I think things will just, fall over the cliff, and, they'll pump it back up and it'll last for a little while. But what I'm starting to become more afraid of, and it will be the effects of this, the consequences, the political consequences, the societal consequences. Because if you start to lose your job and you see prices start to rise in the environment we already have in the world right now, I could see some, political effects of that. I could see people losing seeing their pension funds actually, diminish in value. That they will not be able to afford sitting their houses and so on and so forth. And it may look like a big of a, gloomy, doomy kind of a picture. But I just think that we have inflation now being reintroduced, which is putting a big limitation onto what central banks can do. And that's why I'm a bit worried about the stagflationary phase, if that's going to develop. And also, if we are not capable cooperating across the Atlantic, also with the US and Europe and so on, because that can also, I guess, as you said, I think it will be best if it's a combined effort to meet this. But again, we're down the road here, and maybe it's a little too much overthinking. I don't know, but I definitely can see the patterns of this, and I could see a very, very severe crisis unfolding if we get into a stagflationary period that can last a year, 2 years before things get settled, because unemployment rising, prices rising at the same time is not something that's going to make people happy, especially also if they see the pension funds is losing their values. And so what are people going to do? How are they going to vote? How are they going to react? Are they going to go out on the streets with pitchforks and the likes? I mean, I don't know, but I could see that situation arise in a lot of also, especially also in European countries.
So that's a very concerning outlook, but I understand why you're trying to game it out, because if we're thinking about capital growth, wealth creation, but also preservation, you've got to have a 10-year plan at least, right? You need to be looking out that far. And so you're looking at this blow off top, ultimate greed. We tip over into a recession, but then the authorities come racing in, stimulate the heck out of stuff, pull it back up. But unfortunately, in that attempt, the growth doesn't go up, just inflation does. And then you have this very, very terrible period where you have a lot of dislocation, failures, a financial crisis, social unrest. And then you mentioned a reset, some kind of reset. What does that look like to you?
So in a situation where you start to have, we already see that there is this mistrust to the US dollar. And in that environment where you start to see inflation pushing up higher, that will also be in an environment where the dollar is actually losing value. I don't think that's what you see right now, even though the dollar has been declining somewhat. I think we need to see the dollar actually in deflationary period moving up quite strongly first. But I think it's in the phase where we start to see the dollar actually losing value or just starting to decline, that you're going to see this as well. And you will actually start to see a lot of nations around the world starting to complain about that the US will now be exporting inflation to the rest of the world also. I think that is a normal thing also we see. So I think we'll and at that point there will be a potentially also political. Again, I'm theorizing here and I'm speculating, hypothesizing. We need to think what is the next natural thing that could come. But in that environment, you probably could see that there will be thoughts of can we create something else? Will it be the BRICS that starts to do this thing? It can be like in the 60s where it was France who actually demanded that we want our gold back because we don't think the US is doesn't have a fiscal discipline, and this convertibility of gold, here is all your worthless dollars, give us our gold back. And then famously had Nixon coming off that convertibility back in 71. And I think that will be driving it to some point, because if we see that, that's not a good thing. That will be a very devastating thing to the whole US dollar hegemony and actually the potentially also through the Pax Americana that we've been living under for the last 80 years, that you'll see that if we do not have the strength of the US dollar, and actually there will be inflation moving up and money will start to flow into something we do not want, what will then do? What will the nations then do? Will we have a kind of a Bretton Woods where everybody will sit down and say, okay, maybe it wasn't so smart. Maybe this Nobel Prize for Bernanke wasn't the smartest thing in the world. We are now again destroyed the US, the currency, the reserve currency. What do we do in terms of actually regaining that credibility in to the dollar or whatever it's going to be? And then I think we're going to see a new reserve currency of the world start being put together. It'll be done that only in the time of in a real crisis time where the credibility of the dollar is just plummeting, and I think that will be needed. Otherwise, and people will say, "Well, I don't want to hold the dollars. Why should I hold the dollars and all the debt in the world and all that?" And there needed to be some kind of a reset. I'm not clever enough to see the structure and how they will do that, but I think I could envision that kind of situation where that happens if inflation starts to push up, and with the kind of debt level that we see in the US at this moment, and also in the rest of many places else. Also Italy and in Europe and Greece and Portugal and places like that, they also have problems with their debt levels at this point.
Yeah. So is there a way for investors to protect or hedge against this? I mean, you mentioned that you're rolling the dice and you're going to ride the blow off top, both in stocks and crypto. But is there a way for people who maybe don't want to take that gamble to start to protect against a scenario like that? Or is there nowhere to hide? If it gets that bad, is there anywhere to preserve wealth?
I think there's a lot of guessing of where to go. And I think that is the problem also when you see crypto and then people say, oh, I need to hide into Bitcoin. I need to hide. But I think that's also back to your question on why gold has been running, been moving up so high as it has. I think that is one of the reasons. I think there are people out there starting to realize that this will be the end game. And this is the end game, as I call it. I mean, the end game of this super cycle that I think we're coming to the end of, where we were talking about the the strength of the US dollar. We're talking about that debt now becomes the ultimate problem and all that. So where do you hide out? I think some people will do well in actually just, starting to buy gold, but I think they can also get hit in the deflationary period, because if cash is king, gold is probably not going to do so well in that period. But if you hold it for the next, and you say, I don't care about that, it's more for the next 5, 10 years, 15 years, well, then gold, silver, and so on will probably be, something to buy. Again, I'm not encouraging people to go and buy it here, because I still think there can be a pullback, a large pullback before it happens. But that will be I think that's the place to go. Some people try to think that it could be Bitcoin as well. I'm struggling with that for various reasons, because I kind of think that it depends on what happens now with the whole reserve currency, and if that the US is starting to then buy up, some the holdings of Bitcoins and the like. But I also think that it's something that is more out of the hands of the US and the administrations around the world. And I can see why they will leave it up to something like Bitcoin. But if, we could be in a situation where Bitcoin potentially also could fare well, and in that's it. But again, not in the deflationary period, in a period where money just becomes, something that you throw out the window, because what is it worth anyway? So I think there will be a few things that you can hold on to in that period. And again, also, as I said before, I think there can be a commodity cycle starting off. That's at least what I see. And commodity companies, miners and the likes could be something that will be actually a good place to be at that point.
So let's end with this question, and let's sort of put your sort of pragmatic hat to the side. What's the craziest or wild card event that you could think of that would cause you to sit up and say, wait a minute, maybe everything I'm thinking about needs to change. Maybe I need to alter my thinking. Like, what would be that really sort of opposite of the black swan? What would be that event that would cause you to say that this could be a game changer?
I don't think I can mention just one thing. I think there will be a series of things, events or
Go for it.
Developments that we'll need to see. Yeah, okay. So I think first of all, we'll need to see a real soft landing. Everybody who talks about a soft landing, we can just look at the yields, the levels, and the rates, the payments that people are making on payments on interest. It needs to come down. You need to actually see that people actually do not sit with the knife up to their throat in terms of interest payments. If that happens in an environment where you do not see that the labor market starts to decline, that would be an important step. So if we could start to see that the non-farm payroll stays at 100 and 115,000, 200,000, just going along with that, and you see a yields level actually declining. Now, see, that would be a real soft landing. If that happens, then I would start to say, okay, it seems like they actually manufactured what I think would have been impossible. But not a lot. There's not a lot of signs of that right now. I don't think that is what that they are capable of doing. They can't do it, honestly. I don't see it. But if it happened, that would be the thing that would make me rethink.
And what do you think the best opportunity is in the next 10 years? Based on what you know now, this is not a forecast. Just based on your gut call.
The best,
because you must have a part of your portfolio that you're being safe with. You're going for it with the blow off top and trying to time the end, which kudos to you for doing that.
Maybe
but
crazy.
There's got to be another part where you're like, hang on, this is the safety bit. What do you see the best opportunity for that part?
Well, I mean, if things were to go in, you also think of if they were to go in this kind of more, okay. Well, then I would probably be thinking of where do we see opportunities in AI and the likes. There will be companies out there right now that are are worth nothing, that are just popping up these years. I'm actually very, very optimistic. It may not come out from this interview, but I'm extremely optimistic when it comes to the capabilities of us humans and our ability to innovate, and I think the next 20 years, 30 years is going to see a leap in our technology capabilities that is going to send a lot of things just through the roofs in terms of valuations, in terms of productivity, and so on and so forth. But we're standing right now in a difficult time because of what we have been painting ourselves into the corner financially, economically, and all that, with all the debt we have. But technologically, I think there are something crazy opportunities out there for us to come. So that would be my bet in that kind of environment where we don't go into the abyss first.
It's so interesting because it's like people would maybe be very surprised, especially if they sort of cycle through some YouTube titles attached to you to find out that you're an optimist. Does it feel hard to be warning about difficult times coming? Do you kind of feel like you get the label of Chicken Little or the sky's falling? How do you reconcile that? Right. Because I'm surprised to hear that you're that optimistic and that bullish on tech.
Well, I think it's when you look at I think there's a famous quote in the Big Short where it's nobody's looking, and I think this is what we have this time again, and nobody seems to be looking at the things. I mean, the housing market and all the signs there. We kind of say, we don't. Nobody likes anybody who comes with the bad news, the bearer of bad news. So they kind of discard that. So people will think that I'm I'm just all bearish. I'm not. Honestly, I'm not, and I think global warming and all these things, I'm quite certain we'll find a way of have handling these things. I think we're quite clever as a species, and we'll make the best of things, and we have actually managed to do fantastic over the last many years. I think maybe people think that we are not doing so well, but if you look at all the factors in terms of how old we get, children's mortality, mortality,
and
all
life
and rates and all these things,
increased,
life expectancies, and everything is just going in the right direction. And I think it'll continue to see that path, but we just have ups and downs on that. And so the technology technological development over the next many years, I think is going to be fantastic. And come the next 5-10 years, I'll be looking into where is it really that you'll find these fantastic bits or the investments into some of this into the tech world, biotech and all this. There are great companies out there, great companies that are working on it, and my friend is also working on one that what he can talk about the capabilities of that is just amazing. So I'm very optimistic looking into that.
Well, we have to get through this period. You have to be prepared to have the dry powder in order to take advantage of some of those opportunities.
Stay alive through that, financially stay alive through this period. That will be the hard part.
Fantastic. Henrik, this was gave us so much to think about and so much to try to prepare ourselves for. So thank you so much for this.
Thank you very much. This was a pleasure to talk to you.
If you have any questions about how to navigate the current environment, Wealthion can help connect you with a vetted advisor to get a free portfolio review. Just click the link in the description below or head to wealthion.com/free. There's no obligation, and it will just take a few minutes of your time. Again, that's wealthion.com/free. Thanks so much for joining us. We'll see you again next time.